Welcome everyone to Vested Interest. This is Shane. This is our weekly portfolio update. We do this every Sunday morning where we cover the new capital added to the portfolio. This week we did add $1,549 in new capital to the portfolio. We will cover all the positions that we added to. Right now we are really focused on existing positions. We did recently add the Oxy position there, but we will cover everything that we added, any dividends received, any options we were in for the week. But before we get into the video, I would like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. On this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the positions in the portfolio on a weekly basis. That's what this video is. We're going to cover those weekly purchases in this video. I also do larger purchases if I have extra funds from a bonus or a side job that I've done, something like that. There is nothing to pay for on this channel. I do cover all my investments out in the open. I show you my portfolio at the end of the video every week, or at least the spreadsheet I've created that covers my portfolio. But if you would like to help out the channel, if you could take a moment, hit that thumbs up button down below if you find any value in the content. If you're a dividend growth investor, make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the vested interest community. Click that notification bell so you're notified whenever we put out any new content. Again, I do this series every Sunday morning for the portfolio update review. I also do a stock pick of the day video series Monday through Thursday. Whenever the market's open, we take a look at a company stock that's pulled back on the day and see if it is presenting any value. I have some criteria, high-level criteria, just a screener where we look at it and see if it makes it onto my watch list, where I will do more of a deep dive into the financials of the company, balance sheet, income statements, that sort of thing. And there is the thanks button down below for those of you who are able. You want to buy me a cup of coffee, that's a way you can help support the channel financially. And any funds that I do get from monetizing the channel will go right back into three buckets: my portfolio and both of my daughter's custodial accounts. I'm going to split it up evenly between the three. Have not received any funds from YouTube yet. I've been doing this for a few years now. Just was able to monetize the channel here recently, so we'll see how that goes, and I will share any funds that I do get. Again, special thank you to the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Now that we've got that out of the way, let's get into the video. Starting off with options, nothing on options this week, and I will talk about this a little bit further, but I think, in my opinion, I made a bit of a mistake on the options compared to what we did last week, but let's talk about that in the next slide. All right, a couple of slides. First, we'll cover the dividends we did receive. We did get some dividends from Lam Research Corporation, ticker LRCX. This is out of the information technology sector. We received $28.98 in dividends from the company there on January the 8th. And we do have the drip set on the portfolio. And in my portfolio, I use Ally Bank for my brokerage account. I can only do the drip for all positions or no positions. So my drip is set for everything across the board. So anytime a company in the portfolio pays out dividends, in this case Lam Research, they go right back in. The 28.98 here goes right back in and picks up more shares of that same company. So we picked up 0.37751 shares of Lam Research. This 0.37751 additional fractions of a share here added 34 cents over the next calendar year. And I know that's not a lot, but I will take every penny compounding over time that I can get. And that's what this is. This is compounded interest. This is what you might hear people say, the dividend snowball effect. Whenever they say that, if you don't understand what that means, basically it means that you go in, you buy shares. I've bought shares of Lam Research, so I own shares of this company. Those shares pay me dividends. Those dividends buy more shares. Those new shares add additional passive income. And that is the snowball effect, right? And the hill that snowball is rolling down is time, right? So the more time that goes by, the more this compounds, even if I don't add new capital, right? It'll continue this compounding effect even if I don't add another dime out of my pocket and just reinvest the dividends back into Lam Research. Obviously, it will grow faster if I add new capital along with reinvesting dividends, but that's the dividend snowball effect. Now, first activity, and this is where we'll talk about, in my opinion, I probably made a bit of a mistake this week, but we'll get there in a second. We did add $1,104.49 in new capital on January 6th. With those funds, we picked up 2 shares of Nutrien, ticker NTR. This is out of the material sector. Picked up those 2 shares at $48.28. And this position right here, you can see I picked up 102 shares of Lam Research. This is where I feel like I made a bit of a mistake, ticker LRCX. If you recall, last week I ran an options play on Lam Research. It was called away. So in my opinion, what I should have done is taken those funds and done a cash secured put on this position instead of buying back the shares and trying to do another covered call, which is what I did. I bought back the shares on Monday, 100 shares that I lost plus 2 additional. And to do that, I had to take the around $7,500 that I had, plus the 168 or whatever it was for the new 2 shares, and added an additional, I think, a little right around $300 to be able to buy these back, and then tried to run a covered call that didn't get called. Now, I did freak out a little bit because it jumped up on Monday morning from the $75.22 that it closed out Friday up to 78, almost 79. So that's part of the reason where I bought them back, where I thought, oh man, I'm going to miss out on being able to buy these shares back under $80, which is where I've been wanting to buy them. So I bought them, but I had to add new capital to it. Now they finished the week under $75. So my typical stance is when I'm running the wheel on options, and if you don't know what running the wheel is, I'll kind of explain it a little bit. So I buy shares of a company, I work it up to 100 shares, I run options plays on those companies that I have 100 shares on, and covered calls, so that means I own the shares. Then if those covered calls shares are called away, right, they land in the money, then on the flip side of that, I take the funds that this is what my typical plan is, take those funds and run a cash secured put. Now, what I should have done with Lam Research is stuck to my plan, run a cash secured put at that same strike price, $75. I'd have received that options play. I'd have got the 100 shares back at Friday because it closed under $75 to end the week. I'd have kept the additional funds that I had to use to buy it at $78.38. I'd have got additional capital. So I probably cost myself several $100s here by not sticking to my plan and running a cash secured put with the funds on this position after it was called away last week. I hope that makes sense, and it may not to those of you who don't watch every week and you didn't see that we ran a covered call on this last week. But if you have a plan, even if it's for options, like I said, I use the wheel strategy. So that means I work up 100 shares, run covered calls because I have 100 shares, and you have to have 100 shares to equal one contract. If the company's called away, the other side of that wheel strategy is the cash secured puts side. So again, I should have taken that cash that I received after those shares of Lam Research were called away, run a cash secured put, and then kept doing that cycle, right? And then if I was reissued the shares next week, I would be running a cash secured or a covered call again. So my point is, if you have a strategy, stick to the strategy. Don't freak out because the price is going up or down. Right now, everything's pretty volatile. So the up and down of the market is when a lot of people using options make significant amount of money. But I did. I'll be honest. I freaked out a little bit. I saw it run up to 78, almost $79. Just went in and added the additional capital, bought back the 100 shares that I lost, plus added 2 more shares. But it did significantly cost me several $100s, I would say, not only in options premium, but the amount I had to add extra to the money that I received last week from them being called away. So stick to your plan. That's my point here. Hopefully that made sense. It should make more sense to some of you who watch the videos every week. All right, let's get back into the new capital added here. Out of this $1,104.49, we're continuing to add to our Occidental Petroleum position, ticker OXY. This is the newest position in the portfolio. So long as it stays under the mid-50s, we're going to add to this one until we get to at least 100 shares. So 10 more shares at $51.29. And the new capital added and the new shares picked up, and really on this LRCX position, I am only counting the 2 shares as new shares. So 10 shares of Oxy, 2 shares of LRCX, and 2 shares of NTR. And the 100 shares was already accounted for in the spreadsheet. So $14.96 added in new capital from these positions and the new capital. And we weren't done on January 8th, which was, I believe, Wednesday. The market was not open Thursday. We added an additional $444.85. With those funds, we added one more share to our LyondellBasell Industries position, ticker LYB, at $72.89. And the next two are our weekly buys. We are going to be buying these positions regardless of what the market is. The market looks like it's headed south. So I like that. I might be one of the weird people out there who doesn't mind whenever I see red in the market or in my portfolio, because it means I'm buying shares cheaper, and I like sales on things I'm going to be buying anyway. So I'm looking forward to the market downturn, being able to pick up a lot more shares at cheaper prices with higher yields and future potential future returns, higher future potential returns. But this is part of our weekly buys. Schwab Strategic Dividend Growth ETF, ticker SCHD. We picked up 3 more shares at $27.12. And 1 more share of Vanguard's Total Stock Market ETF, ticker VTI, 1 more share at $290.61. And these will be, again, part of our weekly buys. We're going to pick up at least 3 shares of SCHD, regardless of the market, every week. And same thing with VTI, at least 1 share, regardless of the market, every week. And this new funds, $444.85, the new shares it picked up, added an additional $12.03 in passive income. Total invested for the week, $1,549.34. Total passive income added $27.33. Now here is a quick run through the sector weight update. Communications makes up 9.79% of the portfolio. Consumer discretionary at 4.66%. Consumer staples makes up 9.08%. Energy makes up 7.16%. Financials, this little slice here, at 2.66%. Healthcare makes up 12.14%, industrials at 6.67%. Technology is the largest slice of the pie at 14.56% of the portfolio. Materials makes up 8%, utilities at 7.84%, REITs and real estate here at 7.98%, and ETFs are quickly becoming one of the larger positions and eventually will take over the overall portfolio just by the nature of adding to VTI and SCHD every single week, regardless of the market. And currently makes up 9.48%. But again, I anticipate probably or possibly some point this year, this will be the largest slice, the ETF slice, again, just by the nature of adding to it every week. I think by the end of the year, will probably be the largest slice here. Might be close with information technologies, but I wouldn't be surprised if ETFs is the largest one. Over to the right, as you can see, it's the same percentage broken down as the pie here, and the dollar amounts allocated to each sector as well. And here it is. This is my overall portfolio update. I do show this every week. I want to show you a real portfolio built out over time so you can see the ups and downs, not only in the market, but in individual positions. If you are a person who buys individual positions, every position you buy, even ETFs and index funds, are going to have a 52-week high and a 52-week low. And those individual companies or index funds and ETFs can hit that 52-week high or that 52-week low multiple times throughout the year, or set new 52-week highs or 52-week lows multiple times throughout the year for a multitude of reasons. Could be for bad earnings, for future projections lowered, outlooks lowered. Could be for economic reasons, could be for a war that breaks out overseas. If you're looking at energy companies in the oil and gas sector, it could be for a bad storm in the Gulf of Mexico or in another region that impacts oil shipments or production. So there are a multitude of reasons just for bad press, right? You get some bad news, a CEO retires or gets laid off or fired. There are a multitude of reasons why stocks go up and downs. Could be completely because of people's sentiment. People pile into a stock or decide to sell a stock at the same time. There are a multitude of reasons. And just because you see a stock go green and go up, or you see a stock go red and go down, it does not necessarily mean anything about the fundamentals of the company. It is just the stock price and the stocks doing what stocks do, go up and down over time. But if you have done your research, you understand the fundamentals of the company, how they make their money, what their business is, how they make their revenue, is their revenue growing? You've looked at their balance sheet, their income statement. You see that everything is growing. You see that they should be a stronger company in the next 2, 3, 5 years than they are now. Revenue should continue to expand. Margins are expanding. Those sort of things. And nothing has changed with the fundamentals of the company. If you see red, like Comcast is currently in the red in my portfolio, CVS, Haverty Furniture Companies here, Johnson & Johnson, what is this, Kraft Heinz here, LRCX, there's that Lamb Research position. Lyondell right there. Nutrien right there. Ticker O, the monthly paying. Reed is down right now in my positions. Pfizer is down. SCHD is below my cost basis. Valet, Verizon, all of these different companies that are in the red currently, unless the fundamentals of these companies have changed, which they haven't. I mean, none of these fundamentals, they're not going out of business. Their revenues aren't collapsing. Their margins aren't dropping off. I mean, they might be contracting, some of them, because we're in a potential slowdown right now, in my opinion. But overall, the long-term fundamentals of these companies still look strong. Their free cash flow looks good. Like I said, the revenues aren't dropping off a cliff. If you see that the fundamentals of the company haven't changed, but for some reason right now it looks like the overall market is down and certain sectors definitely are down, then when you see that red, those should be buying opportunities, right? The stock market seems to be the only market where people see red, which I consider a sale, and they run out and want to sell their position at a loss, right? If you walk into a grocery store or a retail store, let's say you're going to a Nike store and buying some shoes. If you want to buy a pair of shoes and you were looking online and they were $75, and you went to the store and whenever you got there, they had them marked down for 20%, only like $60 or $55, whatever 20% off would be. Do you not buy the shoes because they're cheaper? I would be willing to bet you're going to buy the shoes because they're cheaper, and maybe you buy a couple pairs of socks or some sandals or something to go with it, or you just put the extra cash in your pocket, right? The market seems to be the only market where people see red, which should represent a sale if the company's fundamentals are the same, and they decide the company is trash because it's gone down in value. That's not necessarily the case. Separate the cost per share from the company. Understand the company. Figure out a price, whether it's through a discounted cash flow analysis or another way to value a stock, and figure out the price you're willing to pay. And if it drops below that price, you should be willing to buy more of that same stock as long as the fundamentals of the company haven't changed. Like I said, Comcast is down 11%. Well, if I thought it was a good buy at $40.85, why wouldn't I buy it at $36.35? It doesn't make sense to me, but I'll get off my soapbox. Hopefully that made some sense. Here in this column, we're going to see the ticker of all the different positions in the portfolio, total shares, and all of the numbers will be as of the close of business on Friday. Current price, again, as of the close of business on Friday. Market value, average cost per share. So that's what I have into the portfolio. So I'm paying for Ally, for example, $25.89 per share is what I paid. That does include reinvested dividends, even though the current price is $34.19. This is my cost per share. Purchase price here, this does include reinvested dividends. So these are not funds all out of my pocket, as reinvested dividends does account for some of this. Total return here, whether I'm up or down, I'm going to show it. Percent return up or down, again, I'm going to show it. Obviously, red means I'm down. The greener it is, like Owens Corning, that's the one I'm up the most on, 50.76%. So the greener it is, the higher I am up. Sector that they fall in, quarterly, monthly, semi-annual, which months they pay in or how they pay out their dividends. Again, whether it's a quarterly payer, a monthly payer like O, or semi-annual. Current dividend yield as of the close of business on Friday. My yield on cost. These are getting pretty close now, especially with the market pulling back. Portfolio weighting. So what we saw on the previous slide was the sector weightings. This is each individual weighting. And I do have a rule here for sectors. I don't want any one sector to be more than 20 to 25% of the portfolio. That does not necessarily apply to ETFs, as again, I believe that will be a bigger part of the portfolio over time. So I don't mind that one being a larger position over the 20 to 25%. That's more for individual positions. And I don't want any individual positions to be more than 10% to 15% of the portfolio. So I will shift these as I need to make sure I stay within those weightings. Estimated annual income here. Payout months here, dividend growth year over year here, and where it sits at 15% of a 52-week low. I use this as a high watermark. Let's talk about this just for a second. We'll use Owens Corning, ticker OC here as an example. I have been adding to this one along with Union Pacific and a couple others. LRCX is below my cost basis, so we don't really use that one. Oxy is the other one that I've been adding to. But Owens Corning here, let's use this one. The 15% of a 52-week low is $159.50. So I want my average cost per share which is $111.06, to be under that 159.50, right? And even though Owens Corning is currently at $167.43, over where it sits at 15% of a 52-week low, I can add to this position, and it will bring up my cost basis, and I can do that as long as I stay below 159.50, right? So, and that's what I'm doing. I'm adding to Owens Corning, but I'm watching where I'm at as my average cost per share to keep it under 159.50. So even though I'm up, I'm still adding to some positions that are up, not just positions that have pulled back. And to do that, I use this column as a high water mark for what I want my average cost per share to be. Hopefully that makes sense. Now, total shares currently in the portfolio, 6,474.103 shares. Market value of the portfolio, $309,393.32. I do have out of pocket, which does include dividends, right? So this isn't all funds out of my pocket, so to speak. But if I was not reinvesting dividends, right, they would go in my pocket. So I'm just calling it out of pocket money. $301,926.10, but again, does include reinvested dividends. I am up still $7,467.27, or 2.47%. Now, I don't really focus on this. And, I've been up 14, 16, 18% at times. I've been down 14, 16, 18% at times. And I say the same thing whether I'm up or down, right? I don't focus on, it's nice to see total returns that I have, positive gains. I do like that. But to be honest with you, dividend growth stocks tend to grow faster whenever you're not getting good returns, if I'm being completely honest. Slow growing stocks that pay dividends, the dividend will grow faster than fast growing stocks that pay dividends. That's just a reality. Do the math. If you want to look at a dividend calculator, you can do the math. And if you decrease the returns on your stocks per year, you'll see that they do grow faster. So I don't mind some of these slower growers that pay dividends, because if they are slower grower, they tend to grow the dividends faster because of the reinvestments, the compounding effect, right? You're buying back shares at cheaper prices for longer versus a company stock that's run up, and you're buying back shares at higher prices, right? So you're buying less shares as the price of the stock goes up. You're buying less shares with those reinvested dividends versus if a stock staying flat or just growing slower. So I don't really focus on this. That's not my focus. I'm focused on dividend return. You'll see that here in a second. That's why it's circled in red over here. Current yield, 4.037%. My yield on cost slightly higher at 4.13%. And this is what I'm focused on. Again, that's why it is circled in red over here. The dividends paid out by all the positions in the portfolio, and it continues to grow as I add new capital, as the companies in the portfolio pay out dividends, and those dividends get reinvested, whether the market's up, whether the market's down, whether the market's floating sideways. Continues to grow month over month, week over week, quarter over quarter, year over year, and currently sits at $12,489.36. Next week, we will definitely bust over the $12,500 range, and then hopefully by the end of next month, we're into the $13,000 range. We will get out of this $12,000 range. This month, we've been adding to a lot of lower paying dividend yielding companies. Owens Corning, again, if you look at it, only pays a 1.65% dividend. That's one of the ones we're focused on this month. Oxy is another one, only pays a 1.72% dividend. Union Pacific pays a little bit higher at 2.38, but still relatively low. And those three are really in LRCX, same thing. Another one I'm focused on this month at 1.23. So this month, we haven't been adding a lot in passive income, even though we're adding quite a bit of capital, because a lot of the positions we're focused on this month don't pay out a very high dividend yield, though their growth is a little higher, right? Dividend growth on LRCX is around 15%. Oxy's dividend growth is around 22%, right? Owens Corning is around 15.28%. So even though their current yields are low, their dividend growth is significant. So that's part of the reason I want to continue to build out some of these lower paying dividend yield, but higher paying dividend growth. All right. And then the dividend growth year over year is 6.65%. This will change as they change their dividends payouts. You can see here I've started highlighting the ones that already started adjusting or growing their dividends, even though some of that was last year. Enbridge, I think, announced in December. HPQ, same thing. They just paid out a dividend, but they had announced in December that their dividend was going to increase to this 0.289%. This was 0.276%, I believe, earlier. That 4.99% might not be quite right. I need to check that, make sure that's accurate. But I will highlight, that's what these highlight, if you see them highlighted in yellow, that's what that stands for. It means they've raised their dividend already. And as these companies announce their dividend raises, I will highlight them and make those adjustments. Well, that's it. Let me know what you are buying and adding to your portfolio. Big pullbacks recently. The market seems to be on a downtrend. What are you looking to add? Are you sitting on some cash on the side, maybe waiting a little bit? Love to hear from you in the comment section down below. Do we have any of the same companies in common? Are you adding to some of these same ones that I have? Or maybe you're selling out of them. Maybe some of these ones that are in the red, you're selling out of, and you're part of the reason that they're down. And that's a potential as well. So let me know in the comment section down below. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the investment interest community. Drop a comment down below. Let me know what you think of the video. Let me know what you think of my portfolio. Again, do we have any of the same positions? What are you adding to? Would love to hear from you. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.